On September 15, 2008, Lehman Brothers filed for bankruptcy at precisely 1:45 a.m. Eastern Time. Markets opened that Monday morning, seemingly normal. Trading occurred. Prices moved. Transactions settled. But beneath the surface, something had already broken. By mid-afternoon, the commercial paper market, where corporations borrow for short-term operations like payroll and inventory, had effectively frozen. Companies that had easily borrowed millions days earlier found no buyers for their debt at any price. This wasn't a gradual slowdown. It was a light switch turning off. Within 72 hours, the crisis had spread globally. Money market funds broke the buck. The repo market seized. Interbank lending stopped. The machinery that makes modern finance function had simply stopped functioning. The terrifying aspect was not the speed of the collapse. It was how invisible the vulnerability had been until the moment it was not. Markets that appeared liquid, deep, and functional revealed themselves as dependent on confidence that could evaporate faster than anyone could react. Understanding what causes these liquidity freezes, how to identify the conditions that precede them, and why predicting exact timing remains fundamentally impossible, even when structural fragility is obvious. These aren't academic questions. They're practical concerns for anyone whose financial security depends on markets continuing to function. And right now, in early 2025, several indicators that preceded previous liquidity crises are flashing warnings that deserve attention, even as the precise timing of any potential crisis remains unknowable. Liquidity is one of those financial concepts that seems simple until you examine it closely. At its most basic, liquidity means the ability to convert an asset to cash quickly without significant price impact. A Treasury bond is liquid because you can sell billions in minutes at prevailing market prices. A piece of real estate is illiquid because selling takes time and involves price negotiation. But this simple definition obscures the mechanism that creates liquidity in the first place. Markets aren't liquid because assets have some intrinsic quality of liquidity. They're liquid because market makers, institutions that stand ready to buy or sell, provide continuous two-sided quotes. When you sell a stock, you're not finding another individual investor who happens to want exactly that stock at that moment. You're selling to a market maker who's willing to hold inventory temporarily, confident they can offload it to someone else soon. This system works smoothly when market makers have capital to deploy, when volatility is moderate enough that holding inventory isn't terrifying. And crucially, when market makers trust, they can repo out their positions overnight to fund their next day's operations. Remove any of these elements, and the system can break catastrophically fast. The repo market, where financial institutions borrow against securities as collateral, is the hydraulic fluid of modern finance. When it flows freely, everything works. When it freezes, everything stops, regardless of the fundamental value of underlying assets. The mechanics of how liquidity crises unfold follow patterns that have repeated across different markets in different eras with remarkable consistency. It begins with a period of calm, where volatility is low, credit is cheap, and leverage accumulates throughout the system. Financial institutions borrow to amplify returns. Investors reach for yield by taking more risk. Market makers expand positions. Everything appears fine until some event, not necessarily large, creates uncertainty about asset values. Market makers who are comfortable holding inventory become uncomfortable. They widen bid-ask spreads, meaning they'll buy at lower prices and sell at higher prices, making transactions more expensive. If uncertainty persists, they pull back entirely, refusing to provide liquidity. At this point, anyone trying to sell faces a problem. The normal buyers have disappeared. Prices fall not because fundamental value has changed, but because the mechanism for price discovery has broken. Falling prices create margin calls. Margin calls force selling. Forced selling creates more price declines. The feedback loop accelerates until either prices fall far enough to attract opportunistic buyers who don't use leverage, or authorities intervene to provide emergency liquidity, or both. The critical insight is that this process can happen incredibly fast, hours or days, not weeks or months, because modern financial markets operate on leverage and confidence, both of which can reverse nearly instantaneously. Historical examples illustrate how quickly liquidity can evaporate and how difficult it is to identify the precise moment of crisis before it occurs. The 1987 stock market crash saw the Dow Jones fall 23% in a single day. Trading was orderly in the morning. By afternoon, market makers had stopped answering phones. The 1998 long-term capital management crisis threatened to freeze multiple markets simultaneously when a highly leveraged hedge fund faced collapse. The 2008 crisis actually consisted of multiple liquidity freezes, Bear Stearns in March, then Lehman in September, then money markets immediately after. The 2020 COVID panic saw even Treasury markets, supposedly the most liquid assets on Earth, experience dysfunction where prices diverged wildly from theoretical values. Each crisis had different triggers but similar mechanisms. Leverage had accumulated during calm periods. An event created uncertainty. Market makers withdrew. Selling pressure overwhelmed available liquidity. Prices gapped. Systems broke. Authorities intervened. In each case, observers afterward could identify the fragilities that made crisis possible. But in each case, the exact timing and trigger were surprises, even to sophisticated market participants who understood the structural vulnerabilities. This brings us to the uncomfortable question the title of this discussion raises. Can we identify an exact date when markets might freeze? Well, the honest answer is no, we cannot. Financial crises are inherently unpredictable in their precise timing because they depend on confidence, which is psychological, and can shift without warning. What we can do is identify conditions that make crises more likely and monitor indicators that suggest increasing fragility. Right now, several such indicators deserve attention. First, the level of leverage in the financial system has reached or exceeded previous peaks. Margin debt, repo market usage, and derivative exposure all suggest that financial institutions and investors are borrowing heavily to amplify returns. This isn't surprising, given that interest rates, while higher than recent years, remain low by historical standards. And the yield on safe assets doesn't compensate for inflation, pushing investors into riskier strategies. Second, asset valuations across multiple classes, stocks, bonds, real estate, are elevated relative to historical averages on various metrics. High valuations don't cause crashes directly, but they create fragility because there's less margin for error if economic conditions deteriorate. Third, correlation across asset classes has increased, meaning that when volatility rises, things that normally move independently tend to move together. This reduces diversification benefits and can amplify liquidity problems because market makers face losses across their entire book simultaneously rather than gains in some positions, offsetting losses in others. Beyond these broad indicators, specific market structures create particular vulnerabilities worth understanding. The growth of passive investing through index funds and ETFs has created enormous pools of capital that must transact mechanically rather than based on fundamental analysis. When markets fall and these funds face redemptions, they must sell proportionally across all holdings regardless of individual security valuations. This can overwhelm liquidity for smaller, less traded stocks, even when the larger market retains some function. High-frequency trading and algorithmic strategies dominate modern market making. These systems withdraw from markets faster than humans ever could when volatility exceeds programmed parameters. In August 2015, during a flash crash, many stocks briefly traded at absurd prices, blue chip companies at pennies per share, because algorithmic market makers had stepped aside simultaneously, and human traders couldn't react fast enough to provide liquidity. The Treasury market, traditionally the safest and most liquid, has experienced multiple episodes of dysfunction in recent years, where normal relationships between cash treasuries and Treasury futures diverged significantly, suggesting that even this market isn't immune to liquidity stress when conditions deteriorate. The corporate bond market presents particular concerns because primary dealers, the institutions required to make markets in treasuries, and who historically provided significant liquidity for corporate bonds, have reduced corporate bond inventories substantially since 2008. Regulation increased capital requirements for holding risky assets. The role of central banks in creating and potentially resolving liquidity crises deserves careful examination because it cuts to the heart of contemporary monetary policy debates. After 2008, central banks globally became liquidity providers of last resort, not just for banks, but for entire financial markets. Quantitative easing meant central banks purchased trillions in assets, providing guaranteed buyers that supported prices and ensured liquidity. When COVID struck in 2020, the Federal Reserve's response was immediate and massive, not just cutting rates, but announcing unlimited asset purchases and establishing facilities to buy corporate bonds, municipal bonds, and other assets where liquidity had evaporated. These interventions worked in the narrow sense that markets stabilized and resumed functioning, but they created a potential dependency where market participants now expect central bank support whenever liquidity problems emerge. This expectation itself affects behavior. Investors take more risk knowing the Fed will intervene. Market makers reduce inventory knowing they can count on Fed facilities during stress. The system becomes dependent on guaranteed backstops. The question then becomes whether central banks can credibly continue providing unlimited support, and what happens if they either can't or won't during the next crisis. Current policy suggests central banks are trying to reduce their balance sheets and step back from market support, but whether they can maintain this stance during actual crisis remains uncertain. The debt ceiling debates and potential for government funding crises introduce another vector for liquidity problems that's more predictable in timing but uncertain in impact. The United States periodically faces situations where the Treasury Department approaches its legal borrowing limit, and Congress must vote to raise the ceiling or risk default on government obligations. These episodes create windows of uncertainty, usually measured in weeks or months, where the possibility exists, however remote, that political dysfunction could prevent timely resolution. Markets typically handle these episodes calmly because participants assume Congress will ultimately act. But the increasing political polarization and willingness to use debt ceiling votes as leverage in policy negotiations means the assumption of timely resolution is less certain than previously. If a debt ceiling impasse were to reach the point where Treasury seriously considered prioritizing payments or delaying obligations, the impact on financial markets could be severe and rapid. Treasury securities are the collateral underlying much of the repo market. If their creditworthiness came into question, even temporarily, the entire structure of short-term funding could freeze. This represents a scenario where timing is somewhat knowable. We can see debt ceiling deadlines approaching, but the probability and severity of market impact remain highly uncertain because they depend on political decisions that are genuinely unpredictable. Geopolitical events present similar challenges where we can identify risks, but not timing or market impact. Escalation in various global conflicts, disruption of trade routes, cyber attacks on financial infrastructure, or sovereign debt crises in major economies could all serve as triggers for liquidity problems if they create sufficient uncertainty. The difficulty is that markets have proven remarkably resilient to some geopolitical shocks while overreacting to others in ways that seem disproportionate in retrospect. The invasion of Ukraine created initial market stress that largely dissipated within weeks. Various trade tensions and policy changes barely moved markets. Yet sometimes seemingly minor events trigger outsized responses. The challenge for market participants is that the reaction depends not just on the event itself, but on the underlying fragility of the system at the time the event occurs. The same geopolitical development might be absorbed easily in one context and trigger crisis in another, depending on leverage levels, positioning, and confidence at that particular moment. The cryptocurrency and digital asset space introduces yet another potential source of liquidity crisis that has few historical precedents. The market capitalization of cryptocurrency has reached levels where significant volatility or collapse could have spillover effects on traditional finance. Many institutions now hold cryptocurrency exposures directly or through affiliated entities. The collapse of various cryptocurrency exchanges and platforms has already demonstrated how quickly liquidity can disappear in that market when confidence evaporates. The additional concern is interconnection with traditional finance through lending, derivatives, and institutional adoption. A severe cryptocurrency crisis might not stay contained within that ecosystem if it triggers margin calls, redemptions, or losses at institutions that participate in both traditional and cryptocurrency markets. The timing of any such crisis is particularly difficult to predict because cryptocurrency markets operate continuously, move faster than traditional markets, and are less regulated and less transparent about the risk concentrations that might trigger rapid unwinds. Bank failures and deposit flight represent another mechanism through which liquidity crises can develop, as the March 2023 Silicon Valley Bank and related failures demonstrated. Regional and mid-sized banks hold substantial portions of total financial assets and deposits. If depositors lose confidence in one or more institutions and attempt rapid withdrawal, banks that would be solvent under normal conditions can face liquidity crises because assets can't be liquidated quickly enough to meet withdrawal demands. The 2023 episode showed that deposit flight can happen with extraordinary speed when electronic banking allows large depositors to move money with keystrokes. Authorities responded with guarantees and emergency facilities containing the immediate crisis. But the episode revealed that the banking system remains vulnerable to confidence-driven runs regardless of whether underlying assets are sound. The existence of deposit insurance reduces but doesn't eliminate this risk, particularly for the portion of deposits above insured limits, which constitute the majority of deposits at banks serving businesses and high net worth individuals. Identifying which institutions might face runs requires insider knowledge of deposit concentration and asset quality that outside observers typically don't have until problems become public, at which point it's too late to avoid the crisis. Money market funds present a specific systemic risk that played a role in 2008 and remains relevant today. These funds are supposed to maintain a stable net asset value, allowing investors to treat them like cash, but they invest in short-term commercial paper and other instruments that carry some credit risk. If losses cause a fund to break the buck, fall below the dollar per share value, it can trigger redemptions across the entire money market sector as investors flee to safer alternatives. This creates problems because money market funds are major purchasers of commercial paper that corporations depend on for short-term funding. If money market funds face redemptions, they can't buy commercial paper, which means corporations can't fund operations, which can freeze the real economy rapidly. The regulatory changes after 2008 were meant to reduce this risk, but the structures that create the vulnerability remain largely in place. Any event that creates losses in money market holdings could potentially trigger the same dynamic, and the timing would depend on whatever credit event causes initial losses. A corporate default, a sovereign crisis, or some other development that impairs the value of money market investments. The challenge with all these potential triggers and vulnerabilities is that identifying them does not enable prediction of when or whether they'll actually manifest as crises. Markets can remain fragile for extended periods without breaking. Leverage can stay elevated for years. Valuations can persist at high levels. Vulnerabilities can be visible to everyone without translating into actual crisis. This isn't because the vulnerabilities aren't real. It's because crisis requires not just fragility, but a catalyst and a shift in confidence that converts potential stress into actual dysfunction. The catalysts are by definition unpredictable. If they were predictable, markets would adjust in advance and prevent the crisis. The confidence shifts are psychological and social, depending on collective behavior that emerges from countless individual decisions, rather than following deterministic patterns. This means that even sophisticated market participants, with access to the best information and analysis, can identify increasing fragility while being completely wrong about timing. Many investors and analysts correctly identified the housing bubble and financial system fragility in 2005 and 2006. Those who acted on that analysis too early by shorting markets or getting defensive suffered years of underperformance before being vindicated in 2008. Timing matters enormously for practical decision-making, and timing is precisely what we cannot reliably predict. So what are the practical implications of understanding liquidity risk without being able to predict crisis timing? Several considerations emerge that don't require prophecy, but do require clear thinking about risk management. First, understanding that liquidity can disappear rapidly means maintaining adequate cash or cash equivalent reserves becomes more important during periods of elevated fragility. The specific amount depends on individual circumstances, but the principle is avoiding situations where you're forced to sell assets into illiquid markets at the worst possible time. Second, recognizing that correlations increase during stress means traditional diversification provides less protection than many assume. Owning stocks and bonds doesn't help much if both fall simultaneously because liquidity dries up across markets. This argues for a diversification that includes assets with genuinely different risk profiles, though identifying such assets is itself challenging. Third, being aware that leverage amplifies both returns and losses suggests reducing leverage during periods of visible fragility, even though this sacrifices potential upside. Fourth, understanding how crises unfold means being prepared psychologically for rapid changes and having plans in place for various scenarios rather than trying to react in real time during panic. The role of individual investors versus institutions in liquidity crises deserves attention because the experience and appropriate responses differ significantly. Institutional investors with large positions face genuine liquidity challenges during crises because their size prevents easy exit. A pension fund holding billions in corporate bonds can't sell quickly without moving markets and taking substantial losses. Individual investors with diversified portfolios face different challenges, primarily psychological rather than structural. The liquidity of major stock and bond markets typically remains adequate for retail transactions, even during severe stress. The danger for individuals is not inability to trade, but rather panic selling at market bottoms followed by paralysis about when to re-enter. Understanding this distinction matters because it affects what kind of preparation is useful. Institutions need sophisticated hedging strategies and relationships that provide access to liquidity facilities. Individuals need discipline and perspective to avoid emotionally driven decisions during volatility. The practical preparation is less about market timing and more about having a plan that does not require market timing, predetermined asset allocation, rebalancing discipline, emergency reserves, adequate to avoid forced selling, and emotional preparation for volatility. The question of what indicators to watch for signs of approaching liquidity stress comes up frequently, and while no indicator provides certainty, several metrics offer insight into increasing fragility. The TED spread, the difference between interbank lending rates and Treasury rates, widens when banks become less willing to lend to each other, suggesting credit concerns that can precede liquidity problems. The VIX index of implied volatility rises when markets expect increased price swings, which often precedes market maker withdrawal. Repo market rates spiking above normal levels suggest stress in short-term funding markets. Corporate bond spreads widening indicates investors demanding more compensation for credit risk. Trading volumes declining while volatility increases often signals that liquidity providers are pulling back. None of these indicators in isolation predicts crisis, but collectively they can suggest whether the system is becoming more fragile. The challenge is that these indicators can flash warning signals for extended periods without crisis occurring, leading to the constant risk of either overreacting to every spike or becoming complacent about persistent warning signs. The regulatory environment's impact on liquidity deserves consideration because post-2008 reforms changed how financial institutions operate in ways that affect crisis dynamics. Higher capital requirements mean banks hold more cushion against losses, but also hold less inventory of securities, reducing their market-making capacity. Stress tests and liquidity requirements make banks more resilient to individual failure, but may reduce system-level liquidity provision. The Volcker Rule, restrictions on proprietary trading, reduce bank participation in certain markets. These changes probably make the banking system safer in terms of preventing bank failures, but may make markets more fragile in terms of liquidity provision during stress. The trade-offs aren't simple. We've exchanged one set of risks for another set. Understanding this helps explain why crisis dynamics in the next downturn might differ from 2008, even though vulnerabilities exist. The nature of fragility has changed, even if the fact of fragility persists. Central bank digital currencies and the evolution toward digital finance introduce uncertainties about future liquidity dynamics that we can only speculate about. If central banks issue digital currencies that compete with bank deposits, it could affect bank funding and therefore credit provision. If payment systems become more efficient through technology, it could change liquidity needs. If artificial intelligence and machine learning increasingly drive trading and market making, it could alter how quickly markets adjust to new information. These developments might make markets more resilient or more fragile, depending on design and implementation details we can't fully anticipate. What seems clear is that financial market structure continues evolving in ways that make historical precedents imperfect guides to future behavior. The uncomfortable reality is that financial markets exist in a state of managed fragility where normal functioning depends on confidence in systems that can break under stress. This isn't a bug that can be fixed. It's an inherent feature of how modern finance works. Markets provide tremendous benefits: efficient capital allocation, liquidity for investors, funding for productive enterprise. But these benefits come with systemic risks that occasionally manifest as crises. Understanding this doesn't enable prediction of exactly when crisis will occur. Markets might freeze tomorrow or remain functional for years despite visible fragilities. The structural vulnerabilities we can identify create risk, but not certainty about outcomes or timing. This ambiguity is frustrating for anyone seeking clear answers about what to do and when, but it's honest about the actual state of knowledge. We can understand mechanisms without predicting timing. We can identify risks without knowing which will materialize. We can prepare for various scenarios without knowing which will occur. The appropriate response to liquidity risk is not panic or paralysis, but rather informed preparation that does not depend on predicting the unpredictable. Maintaining adequate liquidity yourself. Understanding how your investments might behave during stress. Having plans for various scenarios. Avoiding excessive leverage. Not counting on being able to exit positions quickly during panic. These principles work regardless of whether crisis occurs next month or next decade. They sacrifice some upside during good times. You could earn more by using more leverage or holding less cash, but they provide resilience during bad times without requiring you to correctly time the transition between good and bad. This approach doesn't make for dramatic predictions or claims of superior foresight. It's boring risk management. But boring risk management has the virtue of not requiring abilities, like market timing and crisis prediction, that even professional investors rarely demonstrate consistently. The financial system will experience future liquidity crises. The timing will surprise most people, including those monitoring the exact indicators that, in retrospect, predicted the crisis. Preparation that doesn't depend on correct timing provides more reliable protection than preparation that assumes you'll recognize the crisis before it arrives. That might not be satisfying for those seeking the exact date in the title, but it's probably more useful than false precision about fundamentally uncertain timing. The market might freeze tomorrow. It might remain functional for years. What we can control is not when crisis occurs, but whether we are positioned to navigate it when it does.